For the 2-1 work together, you'll notice that there's two tabs here. So we have our account titles. We learned in 2-2 notes that we have a chart of accounts with our accounts broken up to be a lot more specific. So you're gonna have all these accounts, and then we have our transactions here on this next tab. So in 2-1, we were labeling T accounts. We're gonna do the same thing now, just by date. So notice every date that we have a transaction, we have two T accounts. So the first one, we received cash from an owner as an investment. Question number 1 of our 4 questions says, what 2 accounts are affected? So you may need to go into our account titles and look through what accounts we have. So definitely we received cash, so we're gonna have cash. And then our other account is John Jensen Capital. So we broke down owner's equity into the specifics. So capital is what we use for the investments. So $4,000. So we'll put cash, and then we'll put John Jensen Capital. We received cash. So we learned in chapter 1, we would have done plus 4,000 for cash, plus 4,000 for the owner's equity account. Now we have to determine, okay, we're adding, so what side of the T account does cash increase? Cash is an asset that increases with the debit. Debit is on the left side. So you'll type 4,000. Notice I'm not putting plus 4,000. The plus is on the debit side. That tells anybody looking at it that's plus. No more plus and minus. We have debits and credits. We're going to also increase the capital account. If we look back at our chart here, owner's capital account increases, also known as the normal balance, with a credit. So we're going to credit 4,000. Our left side equals our right side. Debits equal credits. We're good to go. That's transaction number 1. Transaction number 2. On March 3rd, we paid cash for supplies. Okay, so I'm going to come down here on March 3rd. We have to determine what 2 accounts are affected. We paid cash for supplies. We've done this transaction several times now. So we have supplies and we have cash. Those 2 accounts. Okay, so if we added supplies to our supply closet, we increased our supplies. We increased supplies. Supplies is an asset. Assets increase with a debit. So we're going to have a debit of $95 to supplies. Cash is an asset. We paid cash. So cash came out of our bank account, or cash decreased. Cash is also an asset that decreases with a credit. $95. Left side, or debits, equals our right side, or credits. Do another transaction here. On March 4th, we bought supplies on account from Supply Depot, $120. So again, we bought supplies. So supplies is one of our accounts, and we didn't pay cash this time. Accounts payable, Supply Depot. Supply Depot said, hey, we trust you, you could pay us later. So again, we bought supplies. We added $120 worth of supplies to our supply closet. So supplies is an asset. Assets increase with a debit, or the left side. So I'm going to debit supplies. Accounts payable. Accounts payable is our only liabilities that we have. So we added an amount that we owe. So we used to maybe owe them nothing. Well, now we owe them $120. So we need to add that to their account. Liabilities increase with a credit, or the right side. So 1 debit and 1 credit per transaction. So that is how you will continue with the rest of your transactions. Remember that the work together and on your own are for practice, but they're really good practice. I would suggest that before you move on to the graded assignments.